welcome to the first Business and AI seminar. Why we're here is that I have an interest in business, and I have a bias for financial market and questions that are happening in that space. So I thought, why not to allocate the very first seminar to this space and financial markets. So I will introduce Paolo Sironi as our first speaker, and later we will have Mr. Paolo from Financial Supervisory Authority or Finansinspektionen, and Mark Ryan from KTH, and Evelina Antila will joining us from Peltario. So we're going to have its first slot with Mr. Paolo Sironi from IBM Watson. He will introduce himself at a later point. And we're going to have this first session for about 40 to 45 minutes. And we're going to have a break for about 15 minutes. And in the meantime, we will ask you some questions, and we hope that you can participate in those questions. My colleague, Jacob Dexe, he will give you some more information about that process. After the break, we will come back, and we're going to have a panel here, and then we're going to listen to the panel and in the way they're going to relate to this topic and the thesis of Mr. Paolo Sironi. I will hand over to you, Mr. Paolo Sironi, to present the thesis.
Talk about the food.
Oh yeah.
Food.
So
we are humans still.
Yeah.
okay, humans. So complimentary water and some appetizer here. Later we're going to have some wraps, different selections of wraps, and during the break. And this is the exit. I think this is a common standard procedure in Swedish seminars. And then you know the exit from here, I guess. Any questions before we start? Okay. I hand over to you, so.
Thanks for inviting me here today. I'm really delighted to be at the Stockholm School of Economics together with Stockholm AI. We are going to do a long conversation, I presume, to start with, that touches upon many topics, one of which is AI, one is economics, one is banking theory, one is digitization. We try to connect all of these dots. So my name is Paolo Sironi. I'm author of literature and also member of the IBM Industry Academy, which is a think tank that creates conversations bringing around the table financial institutions, the world of the FinTech entrepreneurs, the big tech players, the regulators. But I have a specialty, I believe. I don't want to forget anybody of you, your friends and families, because it's about humans, it's not about technology. We need to make sure that we understand how to turn change into progress. The title of the presentation today is The Financial Market Transparency, the Biological Underpinnings of Finance, which is one of my few books, basically will be this last one. That was published beginning of this year, launched in Davos during World Economic Forum, and shared in a variety of fora, one of which was in the press room of the European Central Bank earlier this year. And the subtitle is To Make the Invisible Hand Visible Again. So basically, we try to identify consequentialist ethics that enable society, starting from the behavior of financial institutions, to take a different path, making sure that everybody is free to reposition. So it's not a top-down approach, it's a bottom-up approach. In essence, what I would call transparent liberalism. So this is the problem that I'm saying today, a bit of banking comics. You remember Oliver and Hardy. So Oliver is sick and is in bed in the hospital, and the central bank is the doctor, tries to save his life. So what did the central bankers do? They basically started pumping a lot of money into the economy, the quantitative easing, they lifted the cost of capital, asking banks basically to change behavior, the risking of their portfolios. So while they saved the system, at the same time, they also created a problem for the system, because the system cannot move as fast or flexibly as it used to. So it's like putting a cast on his leg. So at the same time, the FinTech come and trying to pull Oliver to do something somewhere, to be more innovative, but it's very difficult. You also have the legacy systems, so all of the heritage that squashes the guy to the ground, and the regulator coming from time to time trying to understand whether the patient is doing what it's supposed to do. So did you take the pills, right? It's like a compliance and normative type of action. Now, evidently, the industry is not working anymore. And if the financial services industry does not work or working properly, everybody suffers, because it's one of the most pervasive and diagonal industries in the world. To fix this, we need to understand which is the business model that we need to look at, and that requires a collaborative action. So everybody needs to do something, a step forward or a step backwards. The bankers, the central bankers, the regulators, all of them need somehow to start tweaking the way they look at reality to facilitate the transformation of the financial services industry. So you will see that this is a practical theory, starting from finance, delving into the concept of consciousness and AI, because I want to be practical anyway. I want to make sure that we have a path for implementing change in a way that the resulting solution will be a more inclusive and more diverse environment for everybody. So we start from here. Now, this is Mario Draghi, and I think it was the beginning of September, a few weeks before he handed over to Miss Lagarde. So Mario was asked by a journalist in the audience in the press room of the ECB about the negative interest rates and the point of view of the CEO of Deutsche Bank. So the idea that the negative interest rates can create another collapse in the financial system, therefore the economy. So let's start listening to Mario Draghi's words, and we understand why we are having this conversation today.
Banks would like to have positive rates, unquestionably. So whenever they have negative rates, they don't like it. But I wouldn't go as far as saying that negative rates will cause the collapse of the financial system, because before getting there, one has to look at other things of our banks. For example, the cost-income ratio. Many of our banks have cost-income ratios which are completely way off any average indicator, both in Europe and even more so in the world, if compared with other banks in the other parts of the world. There are certain structural weaknesses in the banking sector, more pronounced in certain parts of the Eurozone than in others. I think these sort of considerations affect much more than negative rates, banks' profitability, banks' capacity to lend. The necessity to adjust the business model to the digitalization, to the changes in technology, is something much more compelling than being angry about negative rates.
So in essence, what he's saying is that the negative rates are not, if you like, proactive, are reactive, to give time to the banks to do something important, to change their business model, because today business model does not correspond anymore to economic reality, also due to the new normal of the central bank, as well as the digital shift that we are seeing going towards the Industry 4.0, which is happening at the time where the drift in the economy is negative, if not null, because we are not anymore in the 50s, 60s, 70s or 80s after the Second World War, where the rebuilding of the Western world was creating everything that we've been seeing and experiencing so far, thinking that neoclassical theory was correct, because in reality was supported by this big wind that was the reconstruction of the world after the Second World War. Therefore, we need a new business model. Everybody talks about the new business model, but nobody says what this new business model should look like, and that's why we are here. Because I think that we can come up with an identification of this business model. This is not just my point of view. It's also an output of the research and the investigation that we're making worldwide, and looking at how the banks in the variety of different constituencies have been working on are changing the way they make money with their clients. So we know that this new business model, like a refoundation of theory of banking and finance, is not anymore about the centrality of the monetary transmission. It's more about the creation of advice for the client. So it's not interest rate margin, it's intermediation margin. So it's not about product transactions, but needs to be about holistic services. In order for that to operate, and for us to be successful, we need to convince people to do that. So transparency is the mechanism that creates consequentialist ethics, aligning the interest of the agents, so that if we do it right, we do something which is very important. We start reconciling the micro with the macro, because economists always had this puzzling element. At the micro level, like behavioral science, they get into some definitions, but then at the macro level, they need to make other assumptions. Well, the two need to be consistent, okay? We cannot have two different points of view, because the reality is always one. And that's why I've been writing a variety of books that you can see here. And the one that we focus on today is the financial market transparency, so the theory and principles of the FMT. Now, why does this matter? And it really matters in terms of an axiology, because as we are learning that banks need to define the value of their work with the clients, if we don't understand what value is, we cannot industrialize the generation of value. But beyond financial services, we need to understand that this is a relevant element for the economy overall, because this is what we are seeing. This is taken by the World Wealth Database, and it's the distribution of wealth in the United States of America starting from 1910 to 2020. So if you look at the 1940, right after 45, the Second World War, you see that the top 0.1% of US Americans, the wealthiest of America, owned basically 20% of US wealth, while the bottom 90% owned the same amount, 20%, and the rest in the middle. Now what happens in the late 80s, beginning of 90s, is that the bottom 90% owns almost 40% of that wealth, and the top 0.1% goes from 20 to 10% or even less. So that means that until the 80s, capitalism, or the American, if you like, point of view and economy, was inclusive. It's not just about growing GDP, but it's distributing growth, to the middle class, helping also the lower class to access the middle class and creating social mobility. But something happens after the 80s and the 90s. We are now back to where we started in 1950s. So now the United States of America is exactly the same distribution of wealth from where it started after the Second World War. No wonder that we see so many social tensions, because uncertainty is rising due to the fact that the way we look at the future is not inclusive and positive, but seems to be more and more exclusive for the many in the lower class and in the middle class. Now, if we overlap this with the S&P 500 graph, you know yourself that every graph has an element of visualization, right? Your eye can trick you, so the scale, seems a bit exaggerated, but you can divide this into these three periods according to what you saw before. So from the 50s to the 80s, the 80s 2008, and after 2008. So the first period is what I would call capitalism, which corresponds in terms of theory of finance to the modern portfolio theory, Markowitz. The markets are very simple. You don't even have high frequency trading. The products are simple. You don't even have fixed income indices, it's primary equity markets. So basically, whatever investment an American would have made, a portfolio of 70-30 or 30-70, he would have retired with money 30 years after. Even Markowitz said, I always did 50-50, right? We will see later on why the efficient frontier has problems in the light of the conversation today. But in the 1980s, something happens. It's the internationalization of finance. Money started flowing at a different speed right after the Bretton Woods, where we detach the generation of money from the ownership of gold. And we see that this is a period of financialism. So basically it's a completely different period. You see more crisis, more evident crisis, more frequent crisis. It's a period that is more complex in finance, money is fast, and products became very complex. You've got derivatives, you've got mortgage-based securities, you've got subprime exposures, you've got CDOs, CDO squares, all sorts of type of financial innovation that not only we saw economists detaching from the description of reality, but we also saw financial innovation, so banks with financial engineering detach themselves using models that don't necessarily correspond to what the real essence of the financial markets is, and that real essence is not physical or mathematical, but is very biological. So the consequence of this is the hyper-monetarism of the central banks, so the intervention of the Fed, of Mario Draghi, right, trying to somehow save the economy, which has other consequences. We see that even though the economies are not inclusive or don't even grow at the aggregate level, the stock market keeps on going up, and every correlation seems to converge towards the positive one. Now clearly, this seemed to be an intermediate period. Even Mario Draghi said that would be like the first measure, but now we know that that seems to be a Q infinity. And the reason is because if we don't change the underlying mechanism, we cannot move out of this monetarist approach. Some say that the future will be digitalism. So we go from capitalism, financialism, hypermonetarism, and maybe the digitalism can be the Bitcoin, can be the Libra. I'm not really sure, even though we have to say in the light of this conversation that even the emergence of the stable coin will accelerate the transformation of financial services the way I'm trying to describe it today. However, what matters to me is that that is never enough. Technology is not necessarily value if it scales a previous business model and set of operations. We need instead to understand how to transform the way financial services work to have a good impact on the economy, avoiding the financialism, making sure that that business is there for the benefit of the customers and the communities and is not auto-referential as it used to be for a long while. So that means what? Bringing back the client to the center stage. But I know that a lot of people talk about client centricity, right? So be client centric, and I'm not sure they really understand what that would look like. For today, we just said the following. If clients, so the Homo sapiens, take center stage, something else will need to go to the periphery. That is the financial product. That means banks will not make money anymore by selling products with embedded fees. And we know, if you look carefully at the way they're making money, that this is happening. The embedded commissions are going down. You saw the ETF, for example, passive investing. You saw the other day the race to zero price war that forced TD Ameritrade to sell itself to charge swaps in the United States of America because they were put out of business by cutting to zero the commissions to access the capital markets for trading on their platforms. But if this is so, we therefore need to understand the essence of the human being, because even Silicon Valley completely misunderstood what is the relationship between people and money, so the essence of the Homo sapiens. And even because you certainly have studied in your classes the concept of the asymmetry of information. Now, when I was here studying, not here in Stockholm, but when I was 20 years old and I studied economics, I remember I was puzzled by this idea of the asymmetry of information. It took me 30 years to go through banking as a banker, FinTech entrepreneurship, and then IBM to get to the point where the problem of this concept is that it is not about information. The asymmetry is a biological asymmetry. You can add as much as information you won't be able to transform this biological asymmetry that makes people relate with money in a way that is not what the economists expect. It is not rational. Because rational it cannot be, because the Homo economicus does not exist. The only one which lives on the planet is the Homo sapiens. And therefore, we need to understand which are these biological macro foundations of the new financial world that relate back to the essence of the Homo sapiens, or as we will see in a moment, the element of consciousness that makes the Homo sapiens particular on the planet. And this is the content of these theory and principles of financial market transparency. They want to do two things. On the one side, open the framework. We are closing the framework further and further in our societies. We need to keep the framework open in order to bring inside elements of long-term investing, social responsibility, the environmental problem. Those are externalities which are not so external. The planet is finite. They are internalities in reality. And on the other side, we need to build consequentialist ethics, because we cannot just impose a model. We need to make sure that we let people free to move around. The reason why I'm saying that we are trying to make the invisible hand visible again in a market and environment which is way more complex. That is exactly how to build impact and inclusion. But we need to do this. We can do this only if we understand the biological macro foundations of finance, which are fundamental uncertainty and the irreversibility of time. I understand that these two concepts can be a bit complex to digest at first, and I hope that through the conversation today we bring some clarity about these two elements. One thing I tell you, if you read one of the latest papers of the Econ Committee, under the request of the European Parliament to address the change of guard between Mario Draghi and Christine Lagarde, to whom I gave a copy of the book in Mexico in May. I hope she read it. They define what the central bank has to do going forward. And out of the three pillars, the third one is fundamental uncertainty. They basically say fundamental uncertainty is the essence of everything. The way we are measuring reality and economic conditions of the past does not correspond to the reality of today, maybe never did. So we need to learn how to open the framework to embrace the concept of fundamental uncertainty, because otherwise we cannot move forward. That means any monetary policy or policy making decision will not be impactful as we learned at school, because fundamental uncertainty is on the rise. So then, let me step into this one, because today we also have the Stockholm AI and the AI element, and I want to see and let you understand how I'm linking all of these topics. So as you see, I'm a peculiar beast. So I'm an economist, I'm a philosopher, I work for artificial intelligence departments of IBM, so on and so forth. So let's say that this is the first element. We defined these two biological foundations as fundamental uncertainty and irreversible time. And now I'm telling you that this is the two elements that explain to us how human consciousness emerge. Now, I believe everything is conscious, but the intensity of human consciousness may be higher than the animals and the plants and the minerals down to the quantum field. Now, the reason why human consciousness emerges so clearly is because of our special relationship as humans with fundamental uncertainty, the need of survival. We forgot that because now we're in beautiful Stockholm, but like a few thousand years ago, we would be sitting somewhere in the forest every moment trying to survive because something can happen to us, less protected than we are today. And then we need to have purpose. You know that happiness is not the real scope in life, because you can have money, you're not happy, happiness comes and goes, but if you have purpose, you can move forward. So purpose is about the time, because we know that we are born, we may do something, and then we will have to die. The time is irreversible, goes only one direction. Now, why does this matter? This way, with finance. If these are the two macro foundations that define how human consciousness emerges, what is finance? Well, finance, to make it very, very simple, is nothing but dealing with uncertainty over time. You see that? Because our money needs to survive. Risk is just an approximation. Okay? Everything that is left out is the one that matters. A, to become very rich. B, to make sure you don't fuck up with your investments. So it's about surviving with money. And also, you need to have purpose with your investment, right? You just don't put money somewhere because you do it because you want to do something, you want to finance your education, you want to finance your retirement, you want to make sure your kids can go to better schools, so on and so forth. Now, here's the point. Investigating and researching in finance is a wonderful opportunity to let you understand the emergence of human consciousness, just because finance is about uncertainty and time. But guess what? What is the biggest problem of the modern portfolio theory, if you know about Markowitz? Well, the fact that the efficient frontier does not have uncertainty endogenous, does not consider it, and is atemporal. So basically misses the two fundamental elements of finance and the centricity of human consciousness, which are fundamental uncertainty and irreversible time. No wonder that the efficient frontier is a nice concept, but nobody uses it. And if you try to use it, it brings you to collapse, because it closes your framework, making you believe that you know everything. Therefore, you can optimize something. But you don't know everything. Even big data is not big enough to contain the future. So we need to be very, very careful with this. And therefore, if this is so, what about AI? Well, you see, there might be different definitions about narrow AI and general AI. Now, I tell you, for AI to be conscious, it needs to be human. If the human micro-foundations, the biological micro-foundations of human consciousness are fundamental uncertainty and irreversibility of time, the algorithm needs to have uncertainty endogenous, so it has to be a biological algorithm. It needs to be capable of surviving. You cannot tell people, wait, they need to recalibrate it because now I have new data sets, I've got new information, doesn't go. Maybe you can do it when you have a very, very narrow application of that, but imagine that you are applying this to manage the oil traffic of Singapore. You will never try to use self-driving cars in Naples, okay? But in Singapore, maybe you can. To simplify to the limit, the guy that do AI will kill me here. But you see what happens. You take the past, the big data, okay, of the last 50 years of Singaporeans driving, you know how they should drive, and therefore you let the algorithm to self-calibrate, or you enforce some supervision on that, and then it goes. And then I fly to Singapore, I am Italian, never been to Singapore, and I'm chewing a gum. And I don't find a bin because the Singaporeans don't throw anything on the street, they never chew, so they don't need it. What do I do with it? I put it on a traffic light, and all of a sudden, the car cannot recognize it because they didn't think that somebody could do that. Silly example to say that if uncertainty comes, the algorithm breaks. You can't tell people, wait 3 weeks because we have to recalibrate it. So if it goes for another one, imagine when you want to use it to map a complex system. So you need to have a biological model. That's why some of the researchers are looking at how to embed uncertainty inside the calibration of the algorithm. But then on the other side, how can AI be ethical? I just come back from a very interesting conference in the Italian Parliament with Luciano Floridi and Federico Faggin, the owner of the Consciousness Foundation and the inventor of the microchip. And I'm like, you see, often we talk about ethics of AI, but we really discuss bias and unbiased of the programmer. For AI to be really ethical, it needs to have a sense of time, because we will learn that a sense of time is what creates consequentialist ethics to synchronize actions and to lead to an explanation of the decisions. Without that, we are talking about bias, we are not talking about ethics inside the algorithm. So then, this was long and it was just an introduction. I think it will be a bit late today. So we have 3 types of stories that we want to share now. First of all, we go back to the global financial crisis, the Greenspan's call, and we try to see how the world responded and why, therefore, the FMT is a different and more complete response to their quest for help. Then we decide what is the Homo sapiens, we discuss it, long lives the Homo sapiens, the Homo economicus is dead or never existed. We therefore understand why the FMT is a practical theory, because it can help the transformation of an industry which is so important, that is financial services. And we discussed a little bit the invisibility of the hand that can become visible again. So we start with Greenspan's call. In 2009, Alan Greenspan is invited to speak in front of the US committee because he's asked by the US policymakers what happened in the financial system. They say, everything is collapsing. Can you please tell us why this is so? I don't know if you ever watched this video, but I want to share that with you. So we listen to the words of Alan Greenspan.
Well, where do you think you made a mistake then?
I made a mistake in presuming that the self-interest of organizations, specifically banks and others, was such as that they were best capable of protecting their own shareholders and the equity in the firms.
And now our whole economy is paying its price. Do you feel that your ideology pushed you to make decisions that you wish you had not made?
Well, remember that what an ideology is a conceptual framework with the way people deal with reality. Everyone has one. You have to exist, you need an ideology. The question is whether it is accurate or not. And what I'm saying to you is, yes, I found a flaw. I don't know how significant or permanent it is, but I've been very distressed by that fact. But if I may I just finish an answer to the question previously?
You found a flaw in the reality.
A flaw in the model that I perceived is the critical functioning structure that defines how the world works, so to speak.
In other words, you found that your view of the world, your ideology was not right. It was not working.
Precisely. No, that's precisely the reason I was shocked, because I had been going for 40 years or more with very considerable evidence that it was working exceptionally well.
This I would call radical candor. So it says we found a flaw in the theory and distressed by the fact that it seemed to work, it doesn't work anymore. We don't know what to do about that. What is this flaw? Well, the agents, the investors, the bankers are rational, and therefore the markets, with more or less as it would favor regulation, become efficient. And this is not the case. So now, how did the world respond to this call for action? Well, in 4 different ways. One was the intervention of the behavioral scientists. We got Nobel Prizes on behavioral science last year, but we have to understand why this is insufficient and actually is not complete. They themselves discuss the fact that rationality and irrationality are not the dichotomy that we should look at, but I want to explain to you why that is a faulty perspective. The second one is definitely the intervention of the central bank, so the monetary policy, the quantitative easing, I want to tell you that too big to fail is an issue here. There's a problem. And then the third is regulatory transparency. You can think about the MiFID II. The MiFID II was conceived at the level of the European Commission as a mechanism to create transparency inside the capital markets union to protect the investor. But it has a problem. The problem is that it looks at the behavior of the financial institutions, but since the asymmetry of information is really biological, it's not about information, if you don't help the individuals, so the customers, the client, the communities, to elevate themselves in their relationship to finance, you will never resolve the problem, because instead of bringing something up, you try to squeeze something down, and it doesn't generate value. The fourth was the attempt of the FinTech community, the digitalization of everything, right? So now we have digital, we got blockchain, we got Bitcoin, we got this and that. No, sorry, this is also an issue, because the biology of the human beings explains that there is a push and pull mechanism. So digital is, in general, a demand technology, but most of the decisions we make for our personal life when it comes to finance are pushed somehow to us in terms of products by an industry, because of our incapability of understanding finance. And it's nothing about education. Is a biological element that triggers to us the perception that the future is open, so we should be aware, so we start being scared, and when we are scared, we can be easily abused by somebody else trying to reassure us with marketing and easy language. So the way out is really the concept of the financial market transparency, because the transparency can create consequential ethics to do what? To help banks define value and build that value for the clients around the concept of goals, goal-based investing, purpose investing, so on and so forth. But if we do not anchor it to something which is theoretically correct, it's just marketing. So we don't want to do marketing here. We want to make sure that we talk about the real needs of the Homo sapiens, of the individuals, not just the marketing strategies to invite people to do more. So let me explain this. We said behavioral science was incomplete. Well, because behavioral science does not map human reality. You see, we don't really have a fight between rationality and irrationality. Even Richard Taylor knows that. Now, rationality, first of all, is only through ex post. I decided to invest this morning in Bitcoin. Tomorrow the market of Bitcoins go up. I'm a genius. Tomorrow goes down, shit, I was exuberant, right? So you never know until the very end, because you don't own the future, even though you're a smart person. Every trader knows that. And irrationality reality is something about emotions, because you see, if you have full set of information, you can make decisions that seem to be more rational. But if you don't have enough information, you will never be rational. So you need to understand emotionally how you relate with the problem. That's why you need to become reasonable. The criteria is the one of reasonability in your decision making. Again, I'm saying you cannot make the most efficient and optimal investment. You can optimize or improve your investment decision making process to create awareness and make sure that when you relate to the financial problem, you don't become too exuberant, you don't put everything at risk without knowing that, and therefore you can survive. It's a criteria of reality. But here it goes. We have at this point Kahneman. You know Kahneman, Nobel Prize for behavioral psychology. And at the CFA Institute last year in Hong Kong, basically says, well, I wasn't really right in the past to say that humans are biased, therefore they can't be rational. Let's listen to what he says.
Much of my career has been devoted to the study of one source of error, which I have called bias. And Thinking Fast and Slow is a lot about biases of judgment and decision making. Noise is a different kind of error. And my thinking these days is that we use the word bias too often, and that we should think about noise as a possible explanation, because noise and bias lead you to different remedies. The remedy for noise is, of course, if you can use an algorithm instead of people, you should use an algorithm, because algorithms are noise-free. And you don't even need artificial intelligence to generate very complicated algorithms. A simple algorithm is better than human judgment in a shockingly high number of cases. But if you can't use an algorithm, then people simulate an algorithm. And what I mean by that is train people in a way of thinking and in a way of approaching problems that will impose uniformity on the way that different people approach questions that require their judgment.
I would say we can discuss now. It makes you right at the beginning, fairly right in the end, and wrong in the middle. But what matters is that the noise is uncertainty, and the idea is that you need to relate to the problem, training yourself somehow in order to try to cope with this issue. When Richard Taylor was in Milano 6-7 months ago for a conference on nudges, he was asked what banks have to do in order to create value for clients. You know what he said? He didn't say nudge for the good, he said transparency first and foremost. Because if you don't have a transparent criteria that create a reasonability concept, you can even abuse a nudge to become a sludge. So we need to become way more foundational in the way we discuss the problem. But we need to be respectful of the human being. The human being is not biased per se. Our brain tells us that the future is open. So instead of changing the human being, we need to start changing finance to correspond to what our biology in reality tells us. And that, going very fast, is the concept of fundamental uncertainty. When Paul Krugman wrote The Age of Diminished Expectations in the 90s, he said children of Americans will have less opportunity to make more money in the future. Therefore, this will create uncertainty and will create social tensions, and this is what has happened. You call it Brexit, you call it Gilets jaunes, you call it whatever you want, sovereignism. The essence is that as the drift is not positive in the economy, fundamental uncertainty is raising to the level of our consciousness, and we think that people start behaving differently. It's not a matter of irrationality. It's a matter of trying to cope, closing our framework with the fact that there's too much uncertainty, and our optimization engine in our head cannot resolve the optimization thing. If we start from this, we know how to resolve the problem. Otherwise, we cannot relate to the real problem. So the second way out was the one of Mario Draghi. Mario Draghi said, well, we need to help banks to survive and the economies to stay afloat, given time to change the business model. This is the famous whatever it takes.
Within our mandate,
in 2011,
the ECB is ready to do whatever it takes to preserve the euro. And believe me, it will be enough.
But it seems it was not enough, because now we have a whatever it takes and number two, so the quantitative is infinity. What matters to me here is that the main problem is the concept of too big to fail. Because too big to fail assumes that if you simplify and create scale, you basically bring stability. But since instability is the norm, that is a faulty concept. Even the dinosaurs were not too big to fail. Some people may say, oh, now there is a trade war. Who would have thought in 2011 there could be a trade war, right? That's when the Econ Committee says there's fundamental uncertainty. So we might have assumed that 10 years ago to deal with a problem in a certain way, the stability concept. And as fundamental uncertainty is very high, it conflicts with the idea of stability. So in reality, we need to point to the concept of anti-fragility, as I will explain later on. The third, we said, is the regulatory transparency, that, however, forgot the fact that it's not just about institutions, but it's about the biological incapability of people to deal with the asymmetry of information. Now, do you know this cartoon? This is South Park. In 2009, it goes live on American television. We see an example of asymmetry of information. The little kid has some money to invest, and he goes to a bank.
I got a $100 check from my grandma, and my dad said I need to put it in the bank so it can grow over the years.
Well, that's fantastic. A really smart decision, young man. We can put that check in a money market mutual fund. Then we'll reinvest the earnings into foreign currency accounts with compounding interest, and it's gone.
What's all gone?
The money in your account. It didn't do too well. It's gone.
What do you mean? I have $100.
Not anymore, you don't. Poof.
Well, what can I do to get back
I'm sorry, sir, but this line is for bank members only.
I just opened an account.
Do you have any money invested with this bank?
No, you just lost it all.
Then please stand aside for people who actually have money with us. Next, please.
So the essence of this one is what? Is that the little kid does not understand finance. And it's not about information. You can add as much as information you want. You will always have a difficulty. So that is what I'm telling you. It is not relevant to use big data and AI to understand the client when it comes to finance. Maybe you can do something better. What matters is to use, in case, AI and data to help the client understand finance. because that is the real problem that needs to be solved. The rest is just on the surface. Now, as we are in the sake of time, in essence, what you can see, if you can go back to my literature, is the push and pull mechanism. Mobile, when it comes to finance, this one is a mechanism of the demand. Most of the revenues of banks these days operate into an offer-driven marketplace. They are pushed to people. So how do you put a push industry into a demand pull-driven mechanism? That's not easy to do that, but there might be some techniques to do it. And that explains to you now why it's so easy to digitize payments, because very demand-driven, but it's very difficult to digitize insurance and somehow investment management in between, because that is where you have more asymmetry of information that has generated the business model of banks to trade with the customers financial opportunities. The only way to make sure that mobile transforms from pull to push is that AI becomes deeply and truly conversational. Only if AI is deeply, truly conversational, creates that relationship you saw in the movie between the kid and the banker, that somehow generates trust through knowledge, good or bad knowledge, and helps the individual to decide and to move forward. Now, I'm not telling you that this is going to happen. I just want to tell you the conditions upon which this product can digitize completely financial services. If it does not happen, that has to be an hybrid model, a collaboration between man and machine. And that's when we get to the essence of this talk, which is the concept of fundamental uncertainty for the Homo sapiens representation. Now, why fundamental uncertainty? Fundamental uncertainty is the reasons why the traders always underestimate the long tail, because in order to decide that they need to assume at some point that uncertainty is not there, and so they get positive and they move forward. I know that I'm a bit delayed. So that is the reason why we stay optimistic. So it's very, very human. It's not a bias, it's a human thing. But if it is a human thing, we cannot avoid uncertainty. It's just like the architects. When the architects build a building, they make sure that that is flexible enough, because when an earthquake comes, it doesn't break. So the same should be the regulator. They should not look for stability, because you cannot anticipate the earthquake or avoid it. You can only make sure that the system is flexible enough to survive. And the other element is the one of time. So the fundamental uncertainty becomes also a regulatory element, as you said, that the Econ Committee is looking at that, to transform the mechanism of stability into one of anti-fragility, and the one of time is the one that has to generate purpose and the alignment of the interest of everybody for the interest of the community.
What is
Do you know what is love? Just to mix it a bit. Now, my colleague said that AI cannot be conscious because it doesn't love, and I'm like, we need to define love, right? So what is love? Love is a synchronization of the time between two people. Real love is the synchronization of irreversible time between two people. Now, it's not time matching. Matching doesn't have a cost constraint. It's like playing tennis and somebody moves and I don't follow him. It's a cost that we need to embrace. Now, the time of the planet started long and is getting shorter. The time of people and businesses is short and it's getting digitally shorter. What we have to do is to make sure that we learn to invest for the long term, so that we start resynchronizing. But that is a way to bring decision making for the long term inside the industry as an industrialized process, so that it is not just marketing. Because it cannot be marketing. We need to create awareness on people when they make the decisions about the impact of the decisions they make. And that is the most relevant thing that a financial institution can do, take care of the creation of awareness for people so that they become more responsible in their investing. So we said that this is to be a practical theory grounded on the macro foundations, which are biological, of fundamental uncertainty and the reversibility of time. We know that since 2008 we are drinking an orange juice made of freshly squeezed margins, because banks cannot make money, because interest rates are too low, because cost of capital is too high, and soon there will also be stable coins. And as Jordan, the governor of the Swiss Central Bank, said, that might even force central banks to become commercial banks, giving money directly to the economy. That's what Ray Dalio says. That's what the Bank of Japan might be doing when they buy the Nikkei index. So what matters to me is the following. Banks are transforming in a way, given and accelerated by the new normal of the central bank, from a center of money creation. So there used to be interest rate margin, a mechanism for the creation of money supply, into something else, which is the delivery of services. So they need to become a center of advisory competencies. But in order to do that, they need to transform. And if you do advisory competencies, you need to define what is value for the client. If the clients have to pay for that transparently. That's why you need to theory to explain how people can understand or not finance. So you move out of the product marketing, which we said is getting to the periphery, and you try to understand what is the real value for individuals as the Homo sapiens is taking the center stage. And this is what? This corresponds to the shift that we may see in the market towards the concept of goal-based investing or goal-based wealth management. In a planning exercise, even the credit is value. If banks in the southern countries of Europe cannot give credit to people because after the price for risk, there is no value for the shareholders. If you price the risk management, but then you plug the credit inside the planning relationship, you can price it. Because you will never be able to personalize to someone a banking offer looking at the assets when the correlation is 1 between all of the passive investing indices. The real personalization comes from bringing the liabilities of individuals inside the equation. That's why it's not just pure advice, but it's financial planning. And this is what some financial institutions are somehow trying to do today. But if they don't understand what value is, they just try, they will fail, and there will be a big disaster for everybody. So we conclude. This is a very complex theory, if you like, and very dense. It starts from the definition of the micro foundations of the Homo sapiens that let consciousness emerge in the spatial relationship with fundamental uncertainty and the irreversibility of time, which we said is nothing but the same definition of finance. So if you don't make it right, finance will never work as long as there is a wind that blows very hard. There is the Second World War reconstruction process, and I hope we don't get into the third to get the wind blow again. When US President Lincoln in 1862 wrote this statement 1 month before the Declaration of Right to free the slaves from slavery, he said that the dogmas of the quiet past are inadequate to restore the present. So he invited his fellow policymakers to understand that the case is new, so we must think anew and act anew. And you know what he added? He added this one. He said that giving freedom to the slave does something very important. Frees the freedom people, right? Because it enables them to think differently. So if we help the financial institutions to understand the Homo sapiens, we need to free the Homo sapiens. The Homo economicus does not exist. We enable them to understand that there are different and better business models than those of creating distribution of products that only look at volume and not value. And it's the reason why transparency only can make the invisible hand visible again. Because with transparency, we help people relate with uncertainty so that they can position to turn change into progress, to build trust versus uncertainty. I thank you for the time. I know I exaggerated, it was very dense, but we have a discussion afterwards to touch upon some of these points. If you didn't connect to me on LinkedIn, you can take a picture of the QR code and it will